Hello bro and welcome back to the new video. So today we are going to analyze this company called Johnson & Johnson. It's a very famous company and it has a stock ticker JNJ. And the reason why we will analyze it is because tomorrow they have an ex-dividend date. That means if you don't buy the stocks until tomorrow, you will not get the next dividend payment. And as always, when we will analyze the data, we will always use my Excel table that I prepared here. And by doing so, we will follow the 3 rules. We will always analyze the data for the last 10 years. And based on that data, we will decide whether we should buy or sell the stock. And we will also always analyze good things first, then bad things. And at the end, we will have a final decision. And final decision is going to be made based on this checklist that I prepared here. We will just decide whether we should buy or sell the stock, and then we will have here at the end, the final decision. Okay, it's that simple. The good things are, as you can see here on the graph, that total revenue, gross profit, and net income are slowly growing. It's an old company, so of course here we cannot expect to have fast, rapid growth, okay, just like with startups, for example. But nonetheless, bro, you can see that gross profit margin and net income margin are absolutely crazy, okay? So as you can see here, preferably we want to have those values higher than 40% or 20% respectively. But as you can see here, bro, gross profit margin is currently sitting at 96%. Don't ask me why. And the net income margin at 41%. So they are almost doubled as recommended, which is absolutely crazy and absolutely outstanding, bro. Like, I have never seen such good margins in my life. It's crazy. It's absolutely crazy, man. And by the way, gross profit margin can be calculated by dividing gross profit with total revenue, and net income margin can be calculated by dividing net income with total revenue. And the good things, bro, don't stop here, because if we go to the balance sheet, we can see that retained earnings are also growing through the all years. And this is very important and very amazing aspect, because retained earnings basically tell you how much money company reinvests back into itself instead of pay it as dividends to the shareholders. And if the retained earnings are growing, that means that the company is reinvesting all the extra cash back. And that's amazing. We want to see retained earnings growing through the all years instead of making that cash flow to the shareholders, okay? And you can also see here, return on equity, bro, is absolutely fucking crazy. It's absolutely bonkers, because preferably all of the companies have around 10% return on equity, okay? 10% is considered as something good. But here, this fucking company has more than 50%. That's crazy, man. If they invest, for example, 100 million euros into some project, at the end of that project, they will have 50 million euro profit. It's crazy, man. This is one of the highest returns on equity that I've seen in my life. And another amazing thing is debt to equity ratio. We want to have debt to equity ratio always lower than 50%. And this company not only has it lower than 50, but lower than 40. That's crazy, man. This company, so Johnson & Johnson, is one of the few companies that I've analyzed that have debt to equity ratio below 50. It's absolutely amazing, man. But the amazing things don't stop here, because we go to cash flow statement and you can see that capital expenditure is growing. What does that mean? So that basically means that company is reinvesting more and more money back into buying new equipment, new machines, new computers, basically to expand the business. And we also want to see that, because that means that the company, just like with retained earnings, is reinvesting the money back instead of paying it to shareholders. And if you are a dividend investor, just like I am, you also want to see that the stock dividends are growing through the all years, okay? And here you can see that the growth is very good. And I think that Johnson & Johnson is also one of the companies that is paying dividends since around 50 years or something, which is absolutely amazing if you are a dividend investor, okay? The last good thing, bro, is intrinsic value. intrinsic value actually tells you what should be the fair price of this company right now, okay? And preferably, bro, we want to see intrinsic value higher than the current price. And let's take a look at here, okay? So intrinsic value for Johnson & Johnson would be $160, and the company is currently trading at 155, let's say, which gives us the spread of $6, okay? And this is crazy. This is very good because that means that the company is currently undervalued by $6, which means that there is maybe some chance of growth, okay, on the long term. With that being said, bro, let's come now, unfortunately, to the bad things. And there are not that many bad things, to be honest, you know, but we still need to discuss them. So the first bad thing is decreasing operating income, okay? What does that actually mean? So operating income is basically all of the income that will in the future become part of net income or gross profit or total revenue. Okay, this is basically the income from the future. And if the operating income is getting lower than lower, that means that the income in the future is going to be lower as well, okay? Which means that we will not have that many profit, which is absolutely horrible, okay? And another bad thing is also capital expenditure divided by net income. So what does that mean again? That means that how much income does each reinvestment produce, okay? And you can see that here in 2017, for example, they invested into something and they got 111% return on that investment, which is absolutely crazy. And right now they have around 14, 19, 12. You can see that it's slowly decreasing in the last 4 years, which is of course bad to see, okay? So that's why we have to mark this as a sell. Another bad thing is that long-term debt, as you can see here, and total liabilities are growing, even though they are slowly being decreased in the last few years, but overall they have been growing steadily for a couple of previous years, which means that that's a bad sign, you know. Unfortunately, each company has debt, so we cannot avoid that, yeah? And the last thing that is bad is P/E ratio, okay? P/E ratio basically means how much money you have to invest to get $1 back, okay? For example, with this company currently has 20 P/E ratio. That means that I have to invest $20 to get $1 profit out of this company. You know what I mean? So here you can see that I wrote top 8 competitors of Johnson & Johnson, and their average P/E ratio is 36, which is of course lower than 15, it's higher, than 15, what we want to see, but is also higher than P/E ratio from Johnson & Johnson. So here I was a bit torn between, like, should I mark this as buy or sell? But then I decided that I want to be as harsh as possible, so I flagged that as a sell, because even though the P/E ratio is by 16 lower than from competitors, it's still higher than what we want to see with 15, okay? So that actually means that the company is undervalued in terms of competitors, but still overvalued in terms of our evaluation, okay? And now we come to the final decision. We will take a look at this checklist and then see whether we should buy or sell the stock, okay? So let's start. Is company growing? Yes, based on the graphs that you can see here and also here and here in the cash flow. Yeah, it's growing, but very slowly, but it's still growing. That's what we want to see. Are margins above preferable values? Yes, they absolutely are. They are even doubled. You can see here, then debt to equity here, return on equity here. They are absolutely yes. Is debt decreasing? Yes, but most of the years it was not decreasing, so we will mark that as a no. Is company reinvesting? Yes. Take a look at retained earnings, they are growing. Take a look at capital expenditure, it's growing, so that's nice to see. Are dividends growing? Of course they are. Take a look here, they are growing. Is P/E below competition and below 15? It is below competition, but it's still above 15, so that's a no. Is price undervalued in terms of intrinsic value? Yes, in terms of intrinsic value, it is undervalued by $6, so that's a yes, and is priced less than 150 euro, or at least $150. Let's take a look. No, it's just $5 above that, so still we will mark that as a no. We show no mercy whatsoever. And overall decision, as you can see here, is that based on this checklist and based on the data, we should buy this stock. And bro, I agree with this decision. I agree that we should buy this Johnson & Johnson stock, but with small amounts, okay? Because the growth is extremely slow, which is expectable because this company is, I think, already 140 years old. So the growth, of course, is not going to be as same as, for example, for some IT startups like Nvidia or whatever, you know? So slow growth, yeah, okay, but it's still safe, okay? It's an old company, so they have time-proven safety and security. They have time-proven like business model, which makes us additional layer of security and this assured feeling that this company will not go anywhere whatsoever, okay? Another good thing is that they are paying dividends and they are also increasing them on yearly basis. They have excellent margins and they also reinvest into the company. So yeah, you can buy this company, but buy it in small amounts, do the dollar cost averaging, because for increasing your equity, this company is not the best one, but for dividends and some safety, it is. So bro, now you know what to do the hard work and see you on top of the world.